Episode 559, Trading Justice Podcast. Getting back in a rhythm. Start the new year. 2 weeks since the Fed pivot. Feels like it's been 2 months. We're going to get you primed, ready to go. Get back into a rhythm starting tomorrow when the market's open. We're also going to talk the Tackle 25 in our feature presentation. Matt has been hard at work. He feels so relaxed. Like, Matt, when I talk to you, Dolphins lost notwithstanding yesterday. You are so much more relaxed than you've been the last couple of weeks as you've been putting in those really long days, debating companies, looking at fundamentals. Pretty chill this morning, Matt.
You know what? This is my December every December. It's Tackle 25. It's a little bit more this year because we were updating the educational system as well. We expanded it from a 2-hour educational system, basically just introducing people to covered calls. I extended that to a 6 to 7 hour educational setting, and so that took a lot of the time this month, but. You know, once I get into those spreadsheets and I start debating growth fee, cash flow, fundamentals, value, growth fee, value, looking at kind of the type of stocks we want on the list going into next year, trying to take into account the major themes and what we're going to have to be navigating. And so I always get a little bit more relaxed once the list is done, once everything is updated. And so cherry on top, I think, is tomorrow during the coaches show when we present the new list to our community. And Mark, it wasn't unlike any other year. It's difficult. Every year's a little bit difficult when you're thinking about the type of stocks you want on the Tackle 25. What economic conditions are you going through? What's the monetary environment? What are those major themes that could drive the market? And trying to match your list to kind of to navigate those landmines coming down the road as well. So I feel like we put together a great list. I felt like we put together a list that is really appropriate for, the economic, monetary, geopolitical environment going into 2024. We had about 12 stocks that were replaced from the 25 from 23, and that's about normal, I would say. That's about normal. We had a lot of turnover on this secondary list, though. Dividend Fireworks had, I believe, 8 new stocks on it. Poor Boys Covered Calls, I want to say, had 8 new stocks on it. And then the Dirty Sexy Money list, which is kind of our boomerang growth, aggressive, a little bit higher volatility. Love that list. And that has 9 new components on it as well. So pretty standard turnover in the Tackle 25, a little bit more turnover than I anticipated going into the other list. But some of that, Mark, was honestly taking stocks that were on the 25, like Microsoft, for example. And I know we're not into the 25 yet, but it's just all over my mind right now, Chucky. Take Microsoft for a second. Microsoft is a wonderful company. I love this company. It's one of the best companies in the world. It would be on the Tackle 25 every year for eternity if they split 10-1 and they gave me a $30 stock versus a $376 stock. And that's the thing. That's the thing about the Tackle 25 is it's not just growth. And so we're not going to put, $4, $5, $6, $7, $800 companies on there because it's a covered call list. It's a cash flow list. And so you do have some of companies like Microsoft that have been on the Tackle 25, Mark, since the inception of the Tackle 25, all the way back in 2015. Microsoft's been on this list, Mark. Microsoft, for example, was on the list when it was a $50 company. It's a $376 company now. It just does not work as well for covered calls when you're that high of a dollar. So where does Microsoft go? It goes on to Poor Boys Covered Call list. And so you do have a lot of turnover in the Poor Boys, but a lot of that is reflecting some of the growth that has been occurring in some of the Mag 7 type quality names that just are not great covered calls any longer.
Yeah, no, and we'll dive deep into.
Can I rephrase that? They're still great covered calls. They're still great stocks, but they're not great covered calls for the vast majority of people. Does that make sense?
Yeah. One of the things that I always take into account, like in my cash flow Vikings practice journal, is accessibility, right?
Yeah.
Some people have $1 million accounts. Some people have $30,000. Some people have all everywhere in between. And
we have people in our communities just starting out learning how to trade versus some amazing long-term veterans that have done this for a very long time. And
have
obviously,
very large accounts. And so you have to take into account, like, just Microsoft, you can't, a lot of people can't do cover calls on it. It's not big enough account. Great company, right?
But everybody can do a bull put spread, and everybody can do a calendar spread, and everybody can do a diagonal spread. And so, and that's what we'll talk about this down the road a little bit. I don't want to steal your thunder in the Skyline, just kind of dominating with the tackle 25.
And that was the market Skyline. Now on to the tackle 25.
Yeah, let's talk tackle now.
Yeah, all right. So here, a market Skyline today. I want just to give everyone a prime, right? Like, because I don't know if you're a lot different than I have. I have been very lax the last 2 weeks. I haven't traded as much. I traded every day, but I've been in holiday rhythm. Right? Call me human, if you will. Right? Kind of checked out a little bit, right? In the rhythm, doing little things, but certainly not full force like I normally have. That's pretty normal, right?
I don't think you're explaining anything that is different from every other human being that is coming out of the last 2 weeks. Whether you work a manufacturing job, or whether you work a sales job, or whether you're a corporate lawyer or a doctor, or you and I talking about market participants, I think everybody around the holiday season, everybody gets a little bit more relaxed, and rightly so. Rightly so. We spend a lot of time with family. We enjoy a lot of food. We get a lot of football. We get Thanksgiving weekend for like 2 straight weeks here, Chucky, at the end of the year. And so I think you're describing the same feeling a lot of people have as they're going back into their routines, whether that routine is a work routine at their job, or whether it's getting, just back into the day-to-day grind of activity here as a market participant. I think you're describing something very normal. And I think it's basically 2 days into the first of the year, we're all going to be back into the exact same routines. And so I just feel like it's something that we all go through. And come that first day, we're all going to hate it, meaning tomorrow, Tuesday, we're all going to hate it. But then again, we're right back into the same routines before 2 weeks ago.
Yeah, no. And so, and one of the things that I've noticed traders do, they check out of the news in particular, right? The news, the aspects, because that oftentimes can be some of the more time consuming, tedious, requires thought. And, a lot of times traders don't want to think during that time, right? And so I just want to do a little primer, where are we on storylines heading into the year? Right? And where are we from a technical perspective? And let's start with that technical perspective. We head into the year with a sizable rally that has lasted 2 months, essentially. We have been in overextended situations for a while now, some days more than others. But when I've been around you long enough to know that, this is your general philosophy in these situations, but also be aware of the overextended situations. And before you hit it really hard, wait for that little cooling off period to play the breakout in the next leg. Is that a pretty good summary?
I think I think you and I have talked a little bit about these conditions before. Rinse and repeat everything you just said. I think you're bullish going into the first of the year. There's no doubt about that. All the trends in the market suggest bullishness. However, you also have a little bit of concern given the fact that you've overextended. You've been overextended in some capacity outside of one particular pattern. And when you're talking about that one particular pattern, you're absolutely right. The last 2 months have been nothing but bull, 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 bull. But there was one pattern in late November, early December for about 2 weeks that you consolidated right around that 4,600 zone. And once you consolidated, what that actually did was brought your RSI down underneath the 70 barrier, which would give a little bit of a reprieve to the overextended situation. And so I do think you're looking at that pattern back in early November, late November, all the way into like the first 2 weeks of December, before you got that big rally coming into the last of the year here. You had a little bit of consolidation there. And what occurred was consolidation alleviates the overextended situations. It doesn't necessarily change the technical read. It doesn't necessarily change anything other than the overextended situation. And so I do think you're going into the first year from a pure technical perspective. You see a trade, you take a trade. But I said this on the halftime report the other day as well, and I'll say it here. In that see a trade, take a trade, I do think you're a little bit more cautious on strategy selection. I do think you're a little bit, when you're thinking delta v theta, I think you're anchoring more on the theta side. If you're thinking directional versus options versus something on a spread perspective, like a bull, instead of single call options, maybe you look at a bull call spread. And so I do think you're a little bit more cautious going into the first of the year. But I also I would say that at any point where you're parabolic on a chart and you're starting to see slowing momentum on the chart, you're seeing a little bit of volatility shift on the chart. I wouldn't say that's a concern as of yet, but it just leads into a little bit maybe consolidation here. And so no, I'm certainly on the you see a trade, you take a trade. I am a little bit more hesitant and cautious on the strategy selection side of the equation. I am anchoring a little bit more theta v delta right now, just given the fact that we are really overextended. But technically, I just think you're dealing with overextended situations. I don't think you're dealing with anything other than that as of right now.
And that's a great recap of the technical. Now, from a macro perspective, from a catalyst perspective, Matt, it is weird, but it was just 2 weeks ago we had what many in the market, myself included, are calling a Fed pivot. And you and I have debated the terminology a little bit there, but a lot of people, myself included, are calling it a Fed pivot. Jay Powell bending the knee, victory, mission accomplished. The market is very optimistic about rate cuts heading into the year. And if I had to say, is there one storyline you should know more than other? It is the market's expectations on rate cuts for 2024.
It's going to be a major story throughout the years because of the differences between where the central bank is in their expectations versus where the market is. That's going to be a major story all year long, in my estimation. What about you?
Yeah, no, because how many cuts does the market currently have?
The Fed is 2 to 3, the market's 6 to 7. And so when you go all the way out to the end of next year, December next year, okay, the market's right in this kind of 3.75 range. And so you're talking that would be about 7 cuts. And so you're 6 to 8 cuts, depending on where the probability factors kind of lie in right now. Right now, I'd say it's averaging at about 7 cuts right now. That's where the market is. When you go all the way out to December of next year. Now, those cuts start to take shape in March. Is when there's a little bit of a debate for the January mark, where you have 15% of the market that expects a rate cut in January, 85% expects maintenance mode. I'm on the maintenance mode. That's where I think they maintain. I don't think they got the data necessarily to make a choice one way or the other, unless there's financing issues we're not familiar with right now. Then absolutely, I think the 85% has it. You start getting into a little bit heavier of a debate when you start getting into March. This is where the market really starts to separate from where the Fed is. The Fed is not expected to cut in their dot plot, in their SEP, and in their statements, especially the statements following the central bank from 2 weeks ago. With most Fed speakers, they've pushed back on early cuts a little bit, and they're now talking about last 6 months, the back half of the year. And so this is the date where everybody's kind of seeing the difference between where the market is versus where the Fed is. The market's on cuts in March. The Fed isn't necessarily on cuts until you start getting into July, maybe even into September. And then there is some expectations that July, September, November, you start seeing a little bit more cuts out of the central bank. what's going to be fascinating is to see that March date. I don't think anything occurs in January. I think we're going to have a lot of debate. I think we're going to talk a lot about it, but I don't think anything necessarily occurs. It's the March date that you start to see the separation where the market expects a cut in March. The Fed is not expected. The Fed, based on their policy statement, based on their speeches, based on their dot plot, they don't expect to cut in March. That's where the market expects to cut. And so that's where it starts to get a little bit divergent on what the market expects with where the Fed expects. Market is expecting, like I was talking about, 7-8 cuts next year, where the Fed is 2 to 3 cuts, markets March, Fed's most likely September. I'm willing to bet that's somewhere in the middle ground, Mark. I'm targeting July meeting for the first cut.
Yeah, no, and so many markets, not just equities, but bonds in particular. For me, rate cuts is a massive story this year, as it would be any year.
Mm-hmm.
And that one of the storylines heading into the year, because a lot of people will throw up graphs that say, well, when the Fed cuts, that's bad for the market. Now, historically, when the Fed's cut, usually sometimes something really bad is happening to prompt those cuts. But the market has this very much Goldilocks attitude right now that as long as the economic data comes in decent and inflation falls, that we could have rate cuts without all of that drama, which would be, well, it would be quite an amazing feat, to be honest. How do you see that aspect, the uniqueness of this rate cut cycle?
I think the pandemic changed a lot of historical narratives regarding market cycles, rate cuts, and the business cycle in general. It's 100% accurate to suggest that rate cuts are typically negative for the market. Would you agree?
Historically, look at the stats, that's absolutely the case.
And I'm just going to do this off the top of my head, looking at the last few market cycles. Fed basically, when you look at the last couple market cycles here, the Fed here, right in this range, was starting to cut. And they cut, 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 and they cut until the very bottom end of the dot-com meltdown. And then they started flatlining for about 2 years before they started doing anything on the liftoff side of the equation. And so as they cut in dot-com, Mark, the market did fall every time they cut. And when you go to the subprime meltdown, Fed's raising rates on the late stage rally, raising rates. All of a sudden, Ben Bernanke right here gives a speech in February of 2008, where he basically talks about how they might be reducing interest rates, but don't worry about it because everything's rosy out there. Everything's fantastic out there. Everything's beautiful out there. Subprime meltdown looks to be, cured. Nothing looks wrong in the subprime market. Nothing looks wrong in the automobile sector. 6 months later, Bear Stearns is out of business. Lehman Brothers out of business. GM, Ford, the car manufacturers need billion-dollar bailouts. Everybody they go to zero interest rate policy. They go to quantitative easing, and they hatch the biggest monetary environment in the history of mankind for the next 2 years, for the next 10 years. That was a cutting cycle. That market cycle is the traditional cycle. And so cuts typically do lead to negative price action. But Mark, the debate is not one of just economic recession or economic depression. It's not one of economic greatness or downward pressure on price. The debate is more centered around inflation and whether or not they can get control of inflation without the economy triggering into a recession. And so to me, it's not about the rate cuts, because we're probably going to get rate cuts regardless of the economic environment this year. Would you agree with that?
Yeah, I think the Fed is absolutely committed to cutting rates. I don't think.
Okay, so
and that's why I call it a pivot, because the language change was too dramatic to think otherwise.
Yeah. So if the economy stays resilient, they're still cutting because of refinancing,
Even if the economy stays resilient, they're cutting this.
And so they're pretty set on some degree of cutting this year. But if you'll recall, back in '08, we did go through an economic recession. If you think about going back to the dot-com area, we did go through an economic recession. In fact, the '08 was not an economic recession. In '08, it was an economic depression. Just people didn't want to talk about the textbook 4 consecutive contracting quarters from April of the second quarter of '08 all the way through the second quarter of '09. And so we were talking about some pretty significant economic deteriorating conditions, Mark. And I'm not here to paint a glorious picture of the United States economy. I am here to suggest that the economic situation today is not the same as the economic situation back in '08. It's not the same as the economic condition in 2000. And I do think that the pandemic and the supply chain crisis during the pandemic, which is not 100% healed, where a lot of companies from around the world were trying to leave China, trying to fix their own supply chains, that's taken a little bit of a prolonged impact on the marketplaces. And so I do think there is a scenario where we've talked about this in the past, where the Fed can cut to alleviate the pressure, given the fact that the economy is still doing relatively decent and the inflationary trend is coming down. Those things were not the case back in '08 and '09. They were not the case back in 2000. So I do think it's easy for people in general to go on social media or to go on talking heads on CNBC and say, oh, this environment is like '08. We were cutting in '08 and look what happened, or we were cutting in 2001 and look what happened. Well, again, I do think they are correct in the assumption of the market cycle, the business cycle, and how interest rates typically do impact the market. But I do think they're discounting some of the supply chain healing over the course of the last 3 years. I think they're discounting the monetary supply injection into the market during the pandemic and how that has slowed down over the last few years. And so I think it's a different environment, quite frankly, Chucky, in my estimation. I don't think we're in front of a repeat of '08. I don't think we're in front of a repeat of the dot-com crisis. Most of the data that would suggest a slightly bullish environment, maybe a neutral environment. When you look at our predictions from last week, most of them were in the pretty shocked. Most of them were in the like 3 to 8% upward movement in price, but I didn't hear a lot of crazy downward, type ability outside of Coach Greg, who typically has a bear lean in most of his predictions.
Yeah, no, and for me, because I was neutral, because I do worry about, does inflation just go away if you have financial conditions easing as much? But why I wasn't bearish has as much to do with companies as anything else.
Yeah.
That one of the big things, because the economy may do what it does, the Fed may do what it does, but companies as a whole, Matt, showed an amazing ability to, despite higher interest rates, manage their companies. Earnings recessions a year ago were all the rage, right? Like all the rage. Companies
it was base case. Earnings recession was the base case last year. It was put out there. Mark, my best call out from last year was no earnings recession.
It was.
And people will not understand that, but all of Wall Street was on earnings recession. All of Wall Street was on earnings recession. And that's their way of preempting the economic recession, is we'll see it in earnings first, then we'll see it in the economy second. We just never saw it in earnings. And I predicted that. That's kind of where my head was at, but we just never saw it in earnings. And one of the things that I think people are discounting a little bit this go around is the moat sizes at some of these companies, Mark. At no point in '08 or before '08, at no point in 2000 or before 2000, at no point in '87 or before '87, at no point before major economic deterioration or market sell-offs did you have the moat sizes that some of these companies in the S&P 500 had. You had upwards of 200 billion in cash reserves at Apple, 140 billion in cash reserves at Google, 120 billion in cash reserves at Microsoft. These companies are built like not just corporations, they're built like nation states at this point at the top areas of the market. And they were just able to withstand so much more than what analysts and people in America thought they were going to be able to handle last year. And it came through. And then the number one thing I think that stood firm that helped all of the earnings was the strength of the consumer. It just has never got out from the market. The strength of the consumer has been one of the variables in the marketplace for the last 15 years. I think it's going to continue to be moving into the future. Obviously, 70% of the American economy is based on consumer spending. Labor stays strong, consumer stays strong. And so you didn't see that deterioration either. And you don't have that going into next year either, Mark. So I'm with you on there's concern out there, but going into 24, I still think you got to be anchoring against the same type of price action and the same type of themes that we've seen develop over the last couple months.
Yeah, bulls have control of the themes heading into this year. Anyone that would argue different is just being stubborn. Does that change?
Remember in 08, when there was expectations of rate cuts, people seeing the rate cuts as bullish or bearish? Like, do you remember?
In November?
In 08.
Like, oh yeah, no, people were panicking. There was real,
like the cuts in 08 were not cuts to alleviate because of inflation was
they were worried about so many other things that it was
And can I say one thing about the path of cuts here? It's one thing if the Fed this year does a 0.25 here and a 0.25 there and a 0.25 here, and they just have this slow, methodical downward drift. If they just stayed at 0.25s, they're not seeing anything out there too crazy. If the Fed comes out one day and says, we're cutting 0.75, that's scary. That to me is really, really, really nerve-wracking, and that would be extremely telling. But if the Fed's just going to cut 2.5 here, cut 2.5 there, Mark, that is not a scary concept from a cutting perspective. People don't realize the 08 saga was not one of a slow drift of 0.25 here and a 0.25. It was a catering of the interest rate conversation. It was 0.50, 0.75, an emergency rate cut here, an emergency rate cut there. And so the rate cutting cycles of the past, and where I think people do get them wrong, is the veracity and the velocity of the rate cuts were extreme in 2008. They were 0.5, 0.75. Let's get it to zero as quickly as possible, where whether you're looking at the market or you're looking at the Fed this year, both the market sees 0.25 in March, 0.25 in June, 0.25 in July, 0.25 in September, 0.25 in October. The Fed sees 0.25 in maybe July, 0.25 in September, 0.25 in October. I don't think anybody's out there thinking, okay, we're going to get, as of right this very second, large rate cuts in a single meeting. And that's where it gets a little bit more nerve-wracking when it comes to cuts, because if they're going to cut 0.75 in one meeting, they're seeing something out there that they're not telling us. But if they're just going to stay on their tune, like think about on the rate increases, it was never an aggressive rate increase. It was 0.5, 0.25, 0.25, 0.25, 0.25, 0.25. You're going to see the same thing on the downside here. I don't think that paints a terrifying environment from a market perspective.
No, and so Bell's in control, and I am giving companies the benefit of the doubt that if their numbers are good, if they've been demonstrating a great ability to manage their business, I'm going to give them the benefit of the doubt over any potential things that might go wrong. And how's this for a transition, Matt? You've done a lot of work to let me know what companies have been managing their business well, what companies are in good fundamental value situation. where I don't have to go spend a lot of time researching because you've done a lot of the work for us. Matt every year puts together a list that we call the Tackle 25. And Matt, I could describe it, but it's your list. You do the honors. What is the Tackle 25?
The Tackle 25 is a curated list of the best 25 stocks for covered calls or cash flow systems going into 2024. There are 4 lists in the system. When you're looking at the Tackle 25, you got the Tackle 25 core list, which is based on covered calls, growth and covered calls. That's what we look for. We look for valuation. We look for growth. We look for great stocks that we can, write covered calls on, cash flow on, but also take into account the growth side of the equation. Try to build a diversified list, very similar to how indexes and ETFs work. Think about the Tackle 25 as a covered call ETF type watch list there. The second list is called Dirty Sexy Money. Dirty Sexy Money is a list of companies that are more on the growth side of the equation. They don't have the valuation necessary to be on the Tackle 25. They don't pay a dividend. They have higher implied volatility, which typically allows traders to apply cash flow systems like naked puts, aggressive covered calls, or the combination of those two called the boomerang trade to maximize their cash flow edge on that. And so that's DSM. We love the Dirty Sexy Money list. Dividend Fireworks is for longer term investments, retirement accounts, companies that meet the Tackle 25 from a fundamental perspective, but they don't have a tremendous amount of volatility in them. They pay a little bit of a dividend. I think the average dividend payment on the Dividend Fireworks is over 4% this year. I think the least dividend on Dividend Fireworks is 3%. You got some stocks that pay 5, 6, 7, 8% on the Dividend Fireworks this year. So really heavy dividend list. Obviously, when you pay a dividend, you typically don't have the volatility to get the cash flow you like to receive on the covered call. So typically you average about 1.5% non-margin on a covered call on Dividend Fire, where you can get 2 to 3% on cash flow rate on the Tackle 25. And so Dividend Fire, more on the longer term investment, capture the dividend, write covered calls, very conservative type list on Dividend Fireworks. And then you got the list that is kind of turning into a little bit of Mag 7 light here, Chucky, is Poor Boys Covered Calls. And those are higher dollar stocks that would be considered a Tackle 25 company, but because of the price tag, not great for covered calls, more for poor boy covered calls, directional spreads, vertical spreads, horizontal spreads, those types of cash flow systems. And so all 4 lists are curated and done and sent to all of our pro member community. And I'm excited for all 4 lists this year.
Yeah, no, man. And, let's go to the Tackle 25. The Tackle 25 has had really decent performance over the last 5 years. Will you just talk just briefly about that performance and then the process you go into in a company making the list? Like, if I'm going to use a list, like, performance itself is important, right? Tackle 25's done pretty good. I also want to know, like, what goes through your brain for a company to make that?
Well, the performance is really, really impressive when you're thinking about just from a growth perspective. The Tackle 25 has actually outperformed the market 4 out of the last 5 years. The only year it did not outperform was last year. And last year, it was a Mag 7 year. Like, it was all growth. When technology and communications are up 55% respectively in the year, growth, the S&P is going to outweigh most other systems out there. That's kind of what occurred last year with the Tackle 25 as well. But 4 out of the last 5 years, the Tackle 25 has outperformed from a pure growth perspective. So if you take the growth of the S&P and you compare it against the growth of the Tackle 25, the Tackle 25 outperforms by about 9 percentage points combined over the last 5 years. And that's decent. That's impressive. I wouldn't say that's a knockout, but that's decently impressive. Where the Tackle 25 shines is on the cash flow side of the equation, not only the growth side of the equation. Remember, it's growth plus cash flow. And so when you're looking at the cash flow side of the equation, writing covered calls, bringing in a little bit of cash flow every single month. And in my projections here, I just projected a 1% cash flow rate every single month. And as you can see, or I'll describe what the Tackle 25 does every single year on the cash flow, when you take into account both growth and cash flow, is you see relative outperformance that is exponential. And so it's very impressive that it beats the S&P on average yearly, but it's the cash flow conversation that makes the Tackle 25 a special list for our community.
Yeah, no, and a stock has to have a pretty good ability to generate covered call premiums to make this list, correct?
Yeah.
Yeah.
Well,
No, I know you and I know the answer to that. I find it particularly impressive that this Tackle 25 does so well, not counting cash flow when you are just cherry picking those stocks. Like you're not allowed to put something that is a little more boring on there. So it could be more volatile, but it ends up outperforming more years than it doesn't. I just find that impressive. It's a good list to work cash flow on. Now, Matt, one of the things that you and I have discussed that you have let me know is that you have this year's list is very cash flow specific, with a tendency to lean towards that area. I think that's very important philosophical consideration. Will you talk about that?
Yeah, I do. There's a couple things that I always debate just in general regarding the Tackle 25 is and not so much on DSM or Poor Boys or Dividend Fireworks, but specifically the Tackle 25 is I always take into account okay, are we going to anchor more on growth or are we going to anchor more on cash flow? And the thing about that is, Mark, is when I'm looking at the growth metrics, when I'm looking at trending analysis, when I look at those metrics that you look for from a growth perspective, EPS, revenue increases, forward-looking guidance, looking at obviously the trends, earnings projections, looking at those types of metrics that would allow you to take into account more growth versus whether you're where you're looking at, say, more cash flow. And I do think on the list this year, I anchored a little bit more on the cash flow side of the equation versus the growth side of the equation. But I do try to find a middle ground there. I would say that I did anchor a little bit more on the cash flow side because I do think there's going to be a little bit more environments this year where cash flow plays a little bit more than delta. And so I do think we are going into a year that, in my estimation, cash flow is going to be one of the names of the game, and it could be a consistent theme throughout the year. And so I did want to anchor a little bit more on the cash flow side of the equation versus the growth side of the equation, but it was close.
And does that play into your general macro look? I know your price target was about 5,000 or so.
It's 5,100, but
that's not much of a delta. Let's go rock the socks off, right?
No, especially with the market at 4830. Like if the market was at 4,500, 4,400, that's a different conversation. But the parabolic move coming into the last couple months, I do think that you have to take into account that parabolic move in the last 2 months when you're looking at projection for performance next year. And so I do think we slowed down a little bit. I do think there's a lot of variables this year, including the Fed being one of them. I think the election is also going to be a very big variable this year. And so there's a lot of variables this year where you could see a little bit of up, a little bit of down, a little bit of up, a little bit of down. I do see some environments of stagnation in the market this year. And so, yeah, I do think the cash flow side of the equation. And again, I think it was a little bit more than last year, not a lot more than last year. I anchored cash flow last year as well. And so I did anchor a little bit more on the cash flow side of the equation. So what does that mean? That means when I'm looking at two companies, right? And I see one company that I think has the ability to grow a lot next year versus one company where I can lock in a 3% covered call rate next year. All things being relatively equal, I would choose the 3% covered call candidate versus the 1.5% covered call candidate, but you can get a little bit more growth. Does that make sense?
And it also means that if we have that environment, having ticker symbols, companies that you can generate a little extra premium on that are quality, that if we do have some ups and downs or sideways, right? It means those ticker selections will lead to better returns for you and allow you to grow money at a faster rate, which is that's the name of the game, isn't it?
Yeah, it's one of them, no doubt.
You know, the name of the game. All right. Give me a couple companies, and we're going to, on Tuesday night for our pro members, Matt is going to unveil the entire list and talk about it all. Give me a little teaser on each list. Give me two companies on each list for the podcast that made the list and talk about why they made this.
Well, one of the themes that I go through every single year on the Tackle 25 is a valuation versus growth, right? We just talked a little bit about cash flow versus growth. I also take into account valuation versus growth as well. Really anchored on the valuation component this year. That probably, when we're talking cash flow versus growth and you anchor more on the cash flow, and you're talking valuation versus growth, that obviously leads to anchoring more on the valuation component. A company that is on the list this year, it was on the list for the first time last year as well, is URBN here, Mark. One of the companies that I really, really like from a covered call perspective. It's not the best trending stock in discretionary. It's not the best trending stock in retail, but that's also not what you look for in terms of building a beautiful covered call list. It's got a slight bullish lean with beautiful neutrality that allows you to just go out there and do your business of writing covered calls and compounding as much as you can. One of those stocks is URBN. URBN is a really good retail type company. Like I was talking about, it's not one of those companies that people are going to talk about all the time. Hey, did you see this parabolic uptrend? Like Abercrombie and Fitch last year, up, went from $10 to $50, did not want to stop. Just a beautiful trend. We caught that one early on. That was a great trending stock. At no point last year, Mark, did we talk about writing a covered call on Abercrombie and Fitch. But URBN here, we rarely talked about all year long in like the halftime report or whatever the case might be, because you're not going to talk about these slightly bullish stocks that you just cash flow on constantly. It's a boring conversation, but be bored here because you cash flowed nonstop all year long on URBN. URBN's got that price tag that you're looking for with the covered call. 20, 30, 40, 50, 60, $70 stocks. That's the name of the game when you're talking about really legitimately great covered call type stocks. Those are not typically in the $200, $300, $400 range. And oftentimes they're not in the $5, $6, $7 range. That 15, 25, 35, 45, 55, those types of price points, URBN really matches that. When you're looking at a covered call, trending conditions are not the most important to me. That's more about how you manage the covered call than making a decision to select a stock to do covered calls on. But when you're looking at the valuation here, URBN last year had pretty decent fundamentals. Mark, URBN went up quite a bit last year and still has better valuation this year than they did last year. So how did URBN go up, but yet valuation come down a little bit? Because, Mark, that earnings conversation just beats all year long on the earnings side of the equation. Had a really good earnings year. PE ratio right now is 12. The sector PE ratio right now is 23. The industry PE ratio is 28. When you're looking at those metrics, URBN has a vastly better valuation argument than any other, when you're not any other stock in this space, but when you're looking at the space itself, it's better than the sector. It's better than the industry. When you look at the forward PE ratio, Mark, you're taking into account that future expectation on earnings. The forward PE ratio is less than the current PE ratio. The FPE is 10.98. The PE is 12.84. That shows you that you have a really good value situation on URBN. And so URBN, one of those stocks on the list that you just look at and you're just like, Okay, is it the sexiest name? No. But is it a great covered call stock? 1000% yes. I would choose Urban over Abercrombie and Fitch any day of the week and twice on Sunday when it comes to cash flow. But when it comes to growth, you would probably take a shot at Abercrombie more than Urban. But that's not what this list is about. This list is about the guarantee of cash flow, not the hypothetical probability of growth. And so should you invest in Urban? Well, that's an individual choice. That do you need a retail company that you're looking to do covered calls on in your portfolio that has proper valuation, if not low valuation, that you know you can have confidence in every single month writing a covered call and bringing in 2 to 3% cash flow? Then the answer is a yes, but it's a yes because you needed it in your portfolio and it met your valuation type arguments. You take into account all the other things we look at, like PEG ratios. Yeah, it just paints the story for Urban even more, Mark. So Urban was on the list last year. It's going to be on the list this year. And that also shows you that I'm not going to remove companies from the list just because they were on the list last year. I'm going to remove companies if there's a better candidate to be a covered call stock on the list. And typically there's about 50% turnover, and that's about what we had on the Tackle 25 this year. So one stock on the list this year, it was on the list last year, was Urban. And again, things changed all the time, but as long as these fundamental variables stay the same, I'm not going to remove Urban from the list. It's the second year it's on the list. It's a really, really good one. I removed Microsoft from the list because the price tag more than absolutely anything else. Another company on the list this year, on the list last year, was
2 comments on Urban.
Yeah,
One,
go ahead.
Urban was a fantastic covered call stock this year. Just fantastic. Did not make you make any difficult decisions along the way. Was just absolutely fantastic. And I love the point, and it's worth reemphasizing. Just because a stock goes up, it does not mean its valuation isn't even. And I think that is one of those things that eventually sinks in your head, right? Is like, oh, that's went up too much over the last 5 years. Well, have the fundamentals gotten even better, right? It's something to just a public service announcement reminder for new traders. That's for
well, and again, Mark, simply because something goes up does not mean the valuation conversation changes. The only thing that changes is the price.
It's such an important lesson.
If earnings is going up and the price is going up, but if earnings is going up more than the price, the PE ratio comes down. And that's what happened with Urban last year, is that price went up, but earnings went up more than what they were last year. And so they have a better valuation this year. You asked me for 2 names on the list, another name on the list on the Tackle 25. Last year, there was a company that is now on dividend fireworks. Energy Transfer was a Tackle 25 stock last year. It is now going over to dividend fireworks because it's a better dividend paying covered call company this year. And so what is replacing Energy Transfer here? A new company to the list this year. I gave you an oldie but goodie, Urban. I'll talk about a new company, Range Resources here, Mark. When I'm looking at Range Resources, again, I'm not looking for parabolic up and parabolic down from a trending perspective. I just don't want to see too much up and too much down, Mark. Too much up and too much down is way too volatile for covered call type analysis. Slight bullish uptrends are beautiful for covered calls. Slight bearish downtrends are, in fact, I want to say a slight bearish downtrend is my favorite condition for a covered call analysis when it comes to long-term stocks that you're doing covered calls on. I love short-term downtrends for covered calls. You can write covered calls, buy them back at net liquidation value, compound the gains back into more shares at a lower dollar, write more covered calls, rinse and repeat. It's a beautiful mindset. It's a beautiful mentality. Range Resources kind of fits that. Its trending analysis is not 2 out up, 2 out down. It's kind of slow, methodical drift up, slow, methodical drift down. And so technically, I kind of like it, number one. But then when I come down into the valuation conversation, Mark, and when I look at the metrics, you asked me a question earlier, what metrics do I look for in terms of assessing the valuation, I take into account the core ones that most people take into account: PE ratio, forward PE ratio, PEG ratio, all your price to everything's price to books, price to sell, free cash flow rate, so on and so forth. When you look at the valuation of all these energy companies, they're all pretty good, Mark, because energy is the lowest valued area in the entire marketplace. And so it's not just a matter of, do you have low valuation? You have to do it in comparison to the rest of the marketplace. And when I look at the valuation on Range Resources here, Mark, I just love the valuation conversation here. 5.45 on the PE, forward PE ratio is 10, slightly concerning, just simply because it's above the current PE ratio. The PEG ratio at 0.45 is the bastion of all things holy and beautiful. From a PEG ratio, anything around the 0.5 range, yeah, I think you just absolutely love here from a valuation perspective. Everything is pretty decent here for Range Resources. And so why did Energy Transfer get removed and Range Resources got added on? Well, it wasn't necessarily because of the fundamentals, because Energy Transfer has a really good fundamental conversation as well. The problem with Energy Transfer, Mark, is it's really more of a dividend paying stock. They pay an extremely high dividend. I think the dividend right now on Energy Transfer, I wrote it down the other day. Let me see if I can hurry and get it for you. The dividend on Energy Transfer is, I wanted to say 9%, but I want to make sure of that 9%. It is right. It's right at 9%. And so Energy Transfer pays a 9% dividend, and you can only get about 1% on a covered call, Mark. And that's if you sell a 0.40 delta. That's not a Tackle 25 stock any longer. It does not have the volatility you need to get into that covered call right around 2%. And if you ever want to look at just one number to understand what I'm talking about, if the implied volatility is less than 20, Mark, you're not going to be able to do a lot of covered calls that would fit the Tackle 25 mentality. Volatility for the Tackle 25 is typically averaging mid 30s. And so 31 to 35, those types of implied volatility numbers are what you're looking for with a really good covered call, because at 20 implied volatility, you can get about a 1 to 1.5% ROI on the covered call. At about a 30 volatility, you can get about 2%. 35, you can get into 2.5 to 3%. And so it's really a volatility conversation when I'm looking at the cash flow expectation. Too much volatility, you know the story of the three bears, right? Too hot, not good enough. Too cold, not good enough. We're trying to Goldilocks this from a volatility perspective. And so Energy Transfer, really good dividend.
One comment.
Yeah, go ahead.
That's one of the things that I think is underappreciated by even myself. It's just not stellar fundamentals that you put the thought into. It's the tactical elements of the selection process, and I think that is very, so not only are you getting a stock that's been fundamentally screened, but it's been gamed out a little bit.
It's been game theory. There's
game
no
theory for some of the situations that you will be facing as a covered call seller.
Well, right? Because
not everyone has sold 40,000 covered calls like myself, right? Yeah. Some people, it's a new process. And I think I like the game theory that you put into it.
Well, when you come over to Range here, or see here, when you come over to Range here, it's a $30 company. It's got 36% implied volatility. You can get a nice little 2 to 2.5% on an at-the-money covered call, 40 delta at-the-money covered call. And fundamentally, Mark, you're not paying too much fundamentally versus what we were looking at with ET. When you're talking about ET's fundamentals, PE ratio 13, forward PE ratio 9, the PEG ratio 1.4, you come back over to Range Resources, Mark. Now, mind you, on Range Resources, you get about twice the cash flow expectation that you have currently on Energy Transfer. The dividend, you get a higher dividend for Energy Transfer, but what are you paying for to get the higher cash flow rate here? You're not really paying much, Mark. Your PE ratio, forward PE ratio, PEG. I think from a pure fundamental perspective, you have better valuation on Range Resources than you even do on Energy Transfer. And so when I was looking at ET versus range, and you know me, Mark, I debate all of these stocks. This was just kind of one of my last debates. It made no sense for me to keep ET on the Tackle 25 when it fit the model more of a dividend payer. And I had this company that I started getting I started just going through my research, Mark. I started really liking Range Resources. AR was another one that got added to the list, but Range Resources here, I just felt like real good valuation conversation, really good on the cash flow expectation. And so quite frankly, it was an easy add to replace Energy Transfer with RRC, but that kind of laid out my mindset a little bit of why I did that, and maybe that opened up a little bit of a understanding of the Tackle 25 in general.
Now, Matt will go over the full list on the coaches show tomorrow night. But Matt, I want a new stock, Dirty Sexy Money.
Okay, I'll give you one per.
Because because a lot of you might go to Tackle 25. I live on Dirty Sexy Money. I love those big premiums. You know me. Right?
Okay, I'll give you one newcomer per list.
That'd be wonderful.
Okay. The newcomer on the poor boy cover call list, this one's easy. It was NVIDIA. NVIDIA fundamentally couldn't be really added last year. Their earnings this year were something to behold. Like I've never seen a company do that good of an earnings perspective and see their valuations come down as aggressively as NVIDIA did last year. But NVIDIA, easy add, $500 company. It's everybody trades it, everybody invests in it, everybody does something with NVIDIA. Felt NVIDIA was a very, very easy add to the poor boys covered call list. Dividend Fireworks list, a new company on Dividend Fireworks. Let me think about the companies really quickly. I'll give you one. I'll give you one that kind of stood out to me a little bit here, Mark. Pfizer got the boot from the Tackle 25. It did find a home on the Dividend Fireworks list, but that's not the one. I'll give you one here. Let's go with, we already talked about an energy company and Range Resources. That's another theme that played out, very commodity driven in the list this year, probably even more so than usual, I would say. I'll give you one, something that is not on the radar typically, because like Newmont Mining's on there, Energy Transfer's on there, Conagra's on there, Pfizer's on there. That's the Dividend Fireworks list. NTR here, Mark, Nutrien. This is a company here that pays, let me get the dividend for you really quickly because it is a Dividend Fireworks type name here. 3.5% dividend here, Mark. This is an agriculture input company out of the basic material space. When you're looking at NTR, coming towards the low point on the chart, nice little reversal on the chart. That's something that I know Coach Mark will absolutely love in reversal analysis is NTR. NTR pays a 3.5% dividend. When you're looking at the valuation conversation of NTR, you're not going to see anything too shabby here, Mark. 13 PE ratio, forward PE ratio at 11, price to sales 0.90. Pretty decent fundamentals. Not the best, I would say, but from a growth perspective, but certainly proper valuation. And you're coming towards the low point on the chart. So I felt on NTR, low point on the chart. Certainly nobody's chasing here. Pays a decent over 3% dividend. Has a really good cash flow rate to it as well for a covered call. So unlike some of the other covered calls on Dividend Fireworks that pays like a 1 to 1.5%, we just talked about Energy Transfer. This bad boy is very liquid. It's got 30% implied volatility. NTR does. You can sell. You really got the debate. Here's what I love about covered calls. When I can debate 3 or 4 different strike prices instead of just 1 or 2 different strike prices, that shows you got proper liquidity here as well. And you can get about a 2% ROI on less than a 40 delta contract on a covered call. I think NTR makes a lot of sense, Chucky. What's your thoughts of NTR on dividend?
No, I mean, Range Resources and NTR both made these are my type of stocks.
That's what the Tackle 25, that's what all the lists are. You're going to love this list.
And so,
specifically, I'm going to love the list this year.
But give me that dirty, sexy one.
All right. So the last one, DSM list, which a lot of people anchor against. There was a really big debate on DSM between it wasn't necessarily DSM, it was Tackle 25 DSM, but it was Still Dynamics versus Cleveland Cliffs. I ended up choosing Still Dynamics over Cleveland Cliffs primarily because of Cleveland Cliffs is a dirty, sexy money candidate. Cleveland Cliffs was a dirty, sexy money candidate last year. They were so close to making the Tackle 25. I just couldn't take Still Dynamics off yet, Mark. It's my favorite still company. Let me give you a new one. I wanted to go with the semiconductor company on Dirty Sexy Money. And there was only a couple that fit the bill for DSM. None of the higher dollar stocks obviously fit DSM type candidates because DSM candidates are naked puts into covered calls. And so price of the stock less than $100 is pretty important for us on DSM. I went with Wolfspeed, Mark, WOLF here. I went with Wolfspeed here.
Great ticker symbol.
It's a great ticker symbol, number one. Number two, it's somewhere towards the low. It's not one of those semiconductors that are all the way up against everything else, more like TSEM and Wolf here, coming from that low to mid tier. And so I kind of liked it coming from the low point here. Fundamentally, when you're looking at WOLF here, Wolf, let me go ahead and look at it very quickly. When you're looking at the fundamentals here, Mark, it's not going to have the same fundamentals that you look at when you're looking at Tackle 25, when you're looking at Poor Boys covered calls, when you're looking at Dividend Fireworks. Those three lists have very specific metrics that I go through that, for example, Cleveland Cliffs didn't make the Tackle 25 because it didn't meet my requirements for the Tackle 25. It did not pass my valuation test. That's why it's still a DSM candidate, not a Tackle 25 one. When you're talking about DSM, dirty, sexy money, these are stocks that you don't necessarily have that fundamental belief system in. You have a belief more on the growth side of the equation than the value side of the equation. You're anchoring more against cash flow than anything else, which means you're also looking for a little bit more volatility. Now, this one's a little bit abnormal. Typically, the type of volatility I'm looking for on DSM is kind of that 50 to 60% implied volatility. 75, 80 gets a little bit up there. You will find stocks that sometimes we'll get into the extreme high volatility on DSM because it's more of an aggressive cash flow list. It's more of an aggressive list in general. What I liked about Wolf here, a couple different things. Number one, cheaper dollar stock, but Mark, you can go all the way down to a 30 delta contract and still get close to 3% ROI on a 30 delta contract. On a naked put, on Wolf, if you wanted to do like a boomerang type system, you could go all the way down to the 18 delta contract, get paid a nice little $70, only 18 days out, Chucky, get paid a nice little $70, and you could only have to put up $380 in margin to get that $70, which means you're cash flowing for over 20% on an 18 delta. That's dirty, that's sexy, and that's money. That's what you're looking for at a DSM candidate. Now, that's one of the more aggressive ones. There's some other names there as well, but that was our semiconductor play for DSM this year. You have a computer hardware, Western Digital made the list again. There was a couple holdovers from last year on DSM, but one newcomer with a lot of volatility, not for the faint of heart. DSM is not for the faint of heart. If you're very conservative, Dividend Fireworks is a beautiful, beautiful list. If you're kind of in that mid zone, kind of you love growth, but you love a little cash flow, that's the Tackle 25. If you want to maximize your cash flow, don't even care about the growth side of it, that's DSM.
I love DSM. I love this list this year. Kimiko left the list this year, didn't it?
It did. Unfortunately.
And Kimiko left. That was a good call. I mean, it was a good. I mean, lot of cash flow on the uranium the last couple of years. I have a feeling it'll be back in the future. I have a feeling it'll be back in the future.
Yeah, I had concerns with Cameco.
Whenever you have a commodity like double in a year, you better be careful. I mean, it just comes down.
Yeah, that's kind of what it came down to. Doubling in a year, but their earnings haven't doubled in a year, Mark.
And so
valuation concerns here. You got a 95 PE ratio, 32 forward. I don't have the same rules for DSM, but when I'm looking at tiebreaker scenarios for DSM, Mark, I'm gonna basically take the lower valuation here. And Cameco, it wasn't that Cameco's a bad company. It's just that I found a better opportunity for us to do things on than Cameco. Cameco is always going to be a stock we look at tackle trading. You're not going to remove that from everybody's list. Cameco is a great stock. It's a great cash flow stock. I just didn't feel comfortable enough with the growth it's had over the last couple of years to put it on the list again with where the valuation versus where the price is. And so I just felt like the better opportunities than chasing Cameco a little bit here.
Now, listen, it's going to be a fabulous year. It is not too late to get the Tackle 25. Talk about some of the new system you did, the cells that we still have running for a few days this week. And then close us out.
Yeah, we still the Tackle 25. Again, we did a major update this year to the Tackle 25. The watch list is the same thing I go through every single year, curating these 4 watch lists. The Tackle 25 is the core 25 covered call list, but we also updated the educational system. And so if you've never done covered calls, if you've never done a naked put, if you've never done a credit spread, if you've never participated in the Tackle 25, if you're just starting out in your cash flow understanding of the financial world, the Tackle 25 educational system is now a complete educational system. It has 5 modules, 15 different sessions, over 6 hours of educational content. And not only do I structure what is a covered call, what is the Tackle 25, what are all the metrics for the Tackle 25, I go through a tremendous amount of education when it comes to the management of covered calls. What to do if the stock is in a bullish uptrend, bearish downtrend, sideways neutral, when to roll an option, when to buy it back, when to close a trade, when to take on growth, when to be more aggressive on the covered call, how to mitigate the risk of an earnings result. I went through it all, Mark. This is a foundational now covered call system that you can understand, not just covered calls, but boomerangs and other option strategies as well. But it's a beautiful system. I'm very proud of it, and I hope everybody enjoys it.
Yeah, no, well said, well said. Listen, we'll be back next week. A little preview to earnings. Yes, I mean, I know earnings. We'll have unemployment data, inflationary data the next week. Fed meeting is going to pick up. Get ready to get out of that low. I will give that earnings preview, break down unemployment data, Fed preview, all of that stuff next week. But have a great week, everyone. Let's get back to work.
Happy New Year, Team Tackle.